Hi, my name is Colbey Alsop. I'm a rising sophomore here, and I'm majoring in finance. Now, today we're going to be talking about debt securities. Now, more specifically, I'm going to be diving into the national debt and how it can affect investments. First, we need to look at the history of the national debt. Debt has been a part of this country since the beginning. The U.S. government first found itself in debt in 1790 following the Revolutionary War. After the war, the U.S. owed $75 million to other nations who helped the U.S. win the war. The debt actually at one point did reach zero, and that was under Andrew Jackson in 1835. Other than that, the debt has been fueled over the centuries by more war and economic recessions. The times when we see debt in this country the worst is during times of deflation. Now, periods of deflation may normally decrease the size of the debt. However, they actually really increase the value of that debt. Since the supply of money is tightened, the value of the money is higher during those deflationary periods. Even if the debt payments themselves remain unchanged, borrowers are actually paying more. Then moving on to the 2008 crisis, we were hit with one of the worst recessions since the Great Depression. Government revenues plummeted and stimulus spending surged to help stabilize the economy from total disaster. Now, this catastrophe, combined with former President Bush's tax cuts and the Iraq and Afghanistan's war, caused the debt to kind of balloon or bubble. Under the two terms of the Obama administration, federal debt held by the public rose from 43.8% to 75.9%. And then under former President Trump, the national debt did decrease since the economy did kind of recover from the 2008 recession. Now, this was until COVID-19 pandemic hit. This caused the debt to skyrocket to kind of where it's sitting at now at about 120% of GDP. Now we got to look at debt versus deficit. First, it's important to understand what the difference is between the two. Simply explained, the federal government generates a budget deficit whenever it spends more than it's bringing in. These activities can include anything from corporate to individual to even excise taxes. Now, to stay afloat in this manner of spending, the U.S. Treasury Department must issue treasury bills, notes, and bonds. These treasury products finance the deficit by borrowing from investors, both foreign and domestic. These treasury securities also sell to big corporations and even financial institutions, and even in some cases to other governments around the world. Now, by issuing these types of debt securities, the federal government can acquire the cash that it's needed to run the country. Now, the debt is simply the accumulation of the government's annual budget deficits. The debt is the total amount of money that the U.S. federal government owes its creditors. Now, government borrowing and spending. Now, the government borrowing money from creditors adds to the national debt. Governments can issue financial securities or even borrow from organizations like the World Bank. Now, the public debt that is owed is calculated daily after receiving end-of-day reports from about 50 different sources, the main one being the Federal Reserve Bank. Now, the national debt can only be reduced through 5 mechanisms, and that is increased taxation, debt reconstructing, reduced spending, default, or monetization of the debt. Now, the federal budget process directly deals with taxation and spending levels and can create recommendations for reconstructing. We can also look at the federal budget to help understand how the government spends money and how we go into debt. A great example of us going into debt is this last year of 2020. Here on the slide, we can see a table of the national debt expenses, and we can see several categories that we've spent far more money than we were budgeted to. That year alone, We were budgeted to be at about $4.79 trillion, and we ended up spending $6.5 trillion. Now, understanding the national debt is very complicated, and even professionals have a hard time agreeing on certain aspects of it. One major misconception about our debt is that China holds most of our debt. This is just not true. In fact, the American citizens hold most of our debt through bonds and other debt securities. Also, GDP is very difficult to accurately measure. It's also very complex. The national debt is not paid back with GDP, instead is paid back with tax revenues. It's another misconception. Now, one approach that we can take that is easier to interpret the national debt is to compare the interest expense paid on the national debt outstanding in relation to the expenditures that are made for specific government reasons. Some of those reasons include education, defense, and public transportation. Now, since the debt plays such an important part of economic progress, it must be understood to appropriately convey its long-term impacts. Now, how bad is the debt? Economists and policy analysts disagree about the consequences of carrying federal debt. Certain aspects are agreed, however. Governments that run fiscal deficits have to make up the difference by borrowing money, which can crowd out capital investment. Now, debt securities issued by governments to service their debts have an effect on interest rates. This is one of the key relationships that is manipulated through the Federal Reserve Bank. Now, the national debt's impact on investments. At the end of the day, more government bonds cause higher interest rates and lower stock market returns, as the US government issues more Treasury securities to cover its budget deficit. The market supply of bonds and existing bonds earn fewer profits than their interest rate. These are sources.